what's your take on how monetary policy is progressing or pivoting this year? Are we going to see a big divergence between the Fed and the other central banks? That would be my first question.
Central banks will not lower interest rates willy-nilly. They will lower interest rates when they see significant and severe economic weakness. So these people who are rooting for lower interest rates from the Fed or from other central banks really have it backwards, because when you see, the Fed's not going to say, oh, we can lower interest rates. The Fed's going to say, our interest rate policy right now is keeping the economy strong and is helping to fight inflation.
Jeff Christian returns to the show. He is the managing partner of the CPM Group. We'll be talking about the commodities, the economy, and Fed policy, and how everything is intertwined, his outlook for the metals and the economy going into the end of 2024. Welcome back to the show, Jeff.
Thanks for having me back, David.
We're speaking this week, a busy week for central banks all around the world. The Bank of Japan just raised rates. The Federal Reserve is meeting this week. Bank of England as well. What's your take on how monetary policy is progressing or pivoting this year? Are we going to see a big divergence between the Fed and the other central banks? That would be my first question.
I don't think we're going to see a divergence. I think what you're seeing is central banks reacting to the reality of what's going on in the economy, their individual economies. And what you're seeing is not so much what gold bulls would like to see, but reality, which is relatively strong economies. There are problems, there are weaknesses that are emerging, but there are still inflationary pressures there. Some of the inflationary pressures are holding up longer and stronger than central banks thought. Thus, the Bank of Japan. The Bank of Japan was the last holdout that had negative nominal interest rates, and now they flipped from negative 0.1 to positive 0.1. So, it's still virtually zero interest rate policy. What you're seeing is that central banks are saying, okay, there are persistent inflationary problems and issues that we have to continue to pay attention to. And the point that we've made, and I think I've made it to you in the past, is, central banks will not lower interest rates willy-nilly. They will lower interest rates when they see significant and severe economic weakness. So these people who are rooting for lower interest rates from the Fed or from other central banks really have it backwards, because when you see, the Fed's not going to say, oh, we can lower interest rates. The Fed's going to say, our interest rate policy right now is keeping the economy strong and is helping to fight inflation. If anything, they may actually wind up increasing interest rates, because if you look at core inflation, there's been some inflationary problems that have been very persistent, and they've been masked by the lower oil and natural gas prices in recent months. And that's what the Fed's paying attention to. But, you have to worry when the Fed and other central banks start lowering interest rates, it will only be in response to worsening economic conditions. And right now, they're all facing relatively decent economic conditions. They see the storm clouds on the horizon, but those storm clouds are not there. Meanwhile, they have time to try to wrestle with that core inflationary problems that you're seeing. Services primarily.
I thought, okay, a few things to unpack there. You said, first of all, they could raise rates. That's no one's told me that on my show just yet, so I want to come back to that. But another important point you made is that they would only lower rates. The Fed would only lower rates if they see weakening economic conditions. Well, what if the economy remains relatively strong or buoyant at least, but inflation comes way down, right? Which is I think what we've seen for most of the 2010s. In that case, wouldn't they still lower rates?
Well, again, if inflation comes way down, if inflation goes down to 2%, which is a very distant place from where we are right now, 3.8 on core inflation, CPI is the most recent number. If you saw interest rates inflation come way down, but the economy is holding up in a good condition, why would the Fed feel that it needs to lower interest rates? Yeah, we have a strong economy, we have low inflation. That's what people have been hiring us to do since 1913. We're actually achieving this at the current interest rate. There was no impetus to lower interest rates if inflation comes down, but the economy remains healthy.
Would the White House not put some sort of pressure on the Fed to lower interest rates just to stimulate the economy a little bit more before the elections?
White House could say whatever it wants. The Fed is independent. And I think that Jerome Powell has demonstrated that he will keep the Fed independent. And I think that if the administration or Congress said, well, you should be lowering interest rates, the proper response on the part of the Fed is you should be getting your fiscal house in order.
Yeah.
Which is actually what they've been saying for a quarter of a century.
Right. Right. Yeah. On that note, okay, we'll come back to the fiscal policies just a minute. Okay. So monetary policy, finish up here. You don't think that there's a high likelihood of a rate cut anytime soon then? The CME Fed Watch tool is projecting a 55% chance of a cut. No. Yeah, it's the CME Fed Watch tool is projecting, first of all, no chance of a cut by the next meeting, which is this week. No chance of a cut by the May meeting. 55%, 58% chance of a cut by June. Is that more or less in line with your expectations? June would probably be the first month of a significant chance of a cut.
I think June is the soonest that you could see a 25 basis point cut. But frankly, our expectation is probably later in the year that the Fed would be more inclined to lower rates. And again, our view is the Fed will only lower interest rates when it sees much more significant problems in the economic realm than it sees today.
Okay. And this is because you're projecting a recession by the end of the year. I know we've talked about this last year. Are you still holding to that view that the economy could see a recession by the end of 2024?
We see the economy could go into a recession in the second half of this year. And if that happens, then if you start sliding toward a recession, then we would expect to see the Fed cut rates. If you're not showing signs of sliding or falling over into a recession, we don't see the Fed cutting rates. So, if I'm telling you that we think that the Fed might cut rates not in June, but after June, that's telling you that we think that the economic environment in the United States will worsen in the final 4 or 5 months of this year.
So, Jeff, a recession is usually reported after the fact, at least a quarter or two after that's already been happened. So wouldn't the Fed react a quarter or two too late if they're looking at data and seeing that there was a recession, now it's time to cut rates? Well, it's already too late, right?
Well, no, you don't look at total GDP and say, oh, we're in a recession. Not if you're the Fed or not if you're an economist. What you do is you look at the components of the economy and you say, how is business investment going? How are consumer demand going for goods and for services across different things? What's happening with labor? Are companies hiring people? Are they laying off people? And you look at the components of it. And one of the great things, in my half century almost now, I guess next year will be the 50th anniversary of the first time I wrote about commodities, and it was oil. But in my half century of watching the economy more closely, what I have seen is a tremendous increase in the capacity to get information in real time. Back in the 70s, you didn't have ideas of what business investment was and orders for goods and services. You looked at things like how many cardboard boxes were companies buying because they thought they would be shipping. We have much more real-time information available to the Fed and to other economists around the world now. And the Fed is not going to wait for GDP to confirm that it's been contracting in the previous quarter. The Fed is looking at business investment, employment, consumer demand, housing purchases, and a variety of other factors, including foreign trade. to determine whether or not the economy is showing increased signs of weakness in economic activity or increased strength in economic activity.
Okay. Jeff, which commodities, if any, have had a pretty good track record of leading economic activity? In other words, are there any commodities out there whose price movements have been pretty good at predicting growth or contraction?
I think, probably the best one is oil. And that's because oil is such an important commodity in driving the overall economy. And so when you see oil prices rising sharply, you know that that is going to have a negative impact on consumer and business expenditures in every other sector of the economy. So strong oil prices are a negative precursor of recession, or a positive precursor of future recessionary conditions. Other commodities are far less important across the full spectrum. Copper is something that, people always talk about Dr. Copper, but I think that if you carefully look at the statistics of the relationship between copper prices and overall economic conditions, the fit is probably far less dynamic than a lot of people would believe that it is. So, I'm not sure that commodities necessarily are a good leading indicator of recession, although higher commodity prices obviously raise the costs of doing business and being a consumer, and that can have a future impact, negative impact on the economy.
Well, correct me if I'm wrong, but you may be assuming that the oil price is driven primarily by the demand side. What if the demand is constant, but then there's supply shocks in either direction?
Yeah. I'm not assuming that the oil price is driven primarily by demand. Supply is extremely important. And one of the things that we've seen is actually pretty strong increases, both in actual output of energy units, but also the capacity to produce more oil, more natural gas, more electricity. So what you're actually seeing is that you are building in some supply protection or protection against supply shocks. If OPEC were to get its act together and decide to impose another embargo, OPEC is far diminished in terms of its percentage of oil. Furthermore, OPEC now realizes that it can raise oil prices, or it can contribute to rising oil prices by slowly reducing oil supply from its places, but it does so at its expense and at the benefit of other oil producers like the United States. And OPEC also has learned the lesson, which we saw them apply after 2003, that as long as you don't cause a spike in energy prices for consumers and industry, and as long as you don't cause gas lines at filling stations, you can raise the oil price very slowly and steadily, and people will continue to pay those higher prices. If you look at the oil price from 2003 to 2008, 2009, it was a steadily moving higher in a very unvolatile fashion. And that reflected the fact that OPEC had learned what Sheikh Yamani had told it in the 1980s, which is, if you don't disrupt the oil supply to consumers, they'll pay whatever price they have to pay to get that oil, because Papa wants his SUV.
Does oil have any predictive power in forecasting geopolitical tensions, risks, and conflicts, for example?
I think that one of the things that you've seen since October 7th is that the international political influence of oil prices and supply are diminished from where they were 50 years ago.
Yes. Well, perhaps the war in the Gaza Strip is really just an isolated incident. It doesn't really have any dramatic impact on the oil market overall. Suppose if the United States were to be dragged into this war, you would see oil prices move dramatically more.
Well, let me be a little bit more thorough and less flippant. The what we're learning from the oil market's reaction to the Israeli attack on Hamas in the Gaza Strip is that oil producers know they can't behave the way they did in 1973 and expect the same political outcomes, that the world is much more interdependent, that the United States and other countries that are not part of OPEC produce a lot more energy, and that they have the capacity to cut back on their energy greater than they did. The other thing that, I just flipped over that I shouldn't have is if you look at the impact in oil and natural gas prices when Russia invaded Ukraine, you can see that obviously energy prices and energy supply do have international political consequences. But you can also see from that same example the extent to which the global oil and natural gas markets can adjust and compensate for those political developments. I think one of the things that OPEC is watching, one of the things that has caused oil producing Islamic governments to say we can't really use oil as a weapon is the fact that they watched when Russia tried to use oil and gas as a weapon, and it had a negative consequence on Europe for a time, but there's a resilience in the international oil and gas markets now that didn't exist in prior decades. And I think that Russia found that out, and I think OPEC watched.
I think one of the questions that investors have been wondering over the last 2 years, ever since the Russian invasion of Ukraine, is which asset or assets should I buy when war breaks out? Is there an asset that you could classify definitively as a safe haven that could perform well or will always perform well during times of conflict, kinetic warfare?
Well, it really depends on the conflict and the nature of the conflict. Obviously, copper and steel are metals that are heavily used in conventional warfare, and you can see, copper is over $4 a pound today, partly because of the consequences of the Russian invasion of Ukraine, and partly because of the increased use of armaments in Gaza by the Israeli defense forces. So you can see those things, but probably the greater impacts are in agricultural commodities because of the international trade in agricultural commodities.
Interesting. Because there's disruptions to the agricultural supply line?
Disruptions to the supply routes, yes.
I'm surprised. Well, I'm not surprised, but some people may be surprised or disappointed you didn't say gold. Is there a reason for that?
Well, gold's important because people buy gold when they are worried or uncertain about the state of the world. And, I'm actually writing a piece for one of our clients right now, which is gold in a world that's not collapsing. And the point that we make is, for half a century, I've been telling investors, you should always be buying gold. You should always have gold in your portfolio. You don't wait for a crisis to buy gold. Obviously, when there is a crisis, you buy gold. If you saw the international political system get worse than it is now, and you may well see that over the next 12 to 24 months, if you saw a worsening in the international political arena, then you might see more investors buying more gold, because gold is ultimately what you want to have if you have to run.
On that note, you have your annual CPM Gold report out next Tuesday, I believe. So let's spend a few minutes talking about gold and some of the themes you're writing about this year. Now, let's just take a look at some of the factors in the macroeconomic landscape. Real interest rates have been rising. The dollar is not collapsing. Inflation is still above 3%, as we've discussed. All these factors look like they should be weighing down on gold, yet gold is healthily above $2,100 an ounce as we speak today. First of all, why is it that these seemingly strong headwinds aren't really making making gold go down in price?
Well, the strongest headwind, I guess, is real interest rates. And that's not very strong, actually. I mean, if you think about it, short-term rates are about 5%. Inflation is 3.8 for core, 3.2 for headline inflation. So you've got 2%, 3%, you've got 2 or 3% real interest rates on the short end, and even less than that on the long end. And if you look at the relationship between real interest rates and gold price changes historically, real interest rates don't necessarily have a negative impact on gold until they're greater than 3%. So we're not there yet. So interest rates have risen sharply. They're up 5% from where they were 2-3 years ago, but they're also lower than they were for most of the period of time from the 1960s through 2007, 2008. So interest rates have risen, and that is a problem for a lot of people, but they haven't risen. I mean, we're not looking at 7% or 11% or 21%, which is what we've seen in the 70s and early 80s, when interest rates were much more problematic for economic growth. So interest rates are the major headwind. It's a very interesting thing right now because as you've seen inflationary pressures persisting and inflationary concerns rise, it's had a negative impact on the gold price. People think of gold as an inflation hedge, but people are looking at those persistent inflationary pressures as not necessarily pushing gold prices higher, but rather contributing to the likelihood that interest rates will stay high, if not rise further. So that's an interesting change that you've got. It's something that we've talked about for decades, but it's the reality. If inflation is rising and people think that it's out of control, then people will buy gold. But what you're seeing is the majority of investors, obviously there's always those people who are running around talking about how inflation is really 40% and stuff like that. But the majority of consumers and businesses and governments and institutional investors and retail investors are saying, oh, inflation is high, it's problematic, but we believe that the Fed and other monetary authorities can control it. And so they're not racing out into gold. That said, let's be honest, gold is at record prices. What kind of person can possibly, well, there are a lot of people who will say, oh yeah, gold prices are low. But the reality is that gold prices are at record highs already. That represents a feeling of uncertainty, a high level of concern on the part of investors. They're not panicking. They're not chasing gold to $2,500 or $3,000 an ounce, but they're saying, I do have enough concerns about the state of the world that I want to have some portion of my wealth in gold. And you've seen this. You've seen over the last 3 years, 25, 26, 24 million ounces of physical gold bought on a global basis by investors. Those are high levels of annual investment demand for gold. They're not as high as what you saw in 2020 or 1980, but they're very high levels compared to the 10, 15, 20 million ounces that you typically see when things are far less worrisome in the world.
If you take a look at the long-term 10-year real interest rate, which is to say we're going back all the way to the late 70s, it's been on a long-term secular decline over the last 40 years or so. Starting from, I'm talking about the real interest rate, real 10-year interest rate, starting from almost 8% to negative a year ago, and then now back to positive territory and rising. Let me just posit this theory, and please challenge me if you think I'm wrong. If the real interest rate will continue its upward trajectory from here, it only means that the long-term price of gold will have peaked at this level. Because if you take a look at the gold price over the last 40 years, it's been pretty much negatively correlated with this downward trend in real interest rates, has it not?
No,
And so going forward, if the real interest rate were to rise, basically gold will have already reached the ceiling at this point.
Well, No, I mean, first off, if we look at the real interest rate, 10-year bond, versus real changes in real gold prices, and the correlation month to month is actually closer to zero. It's not a particularly high level, except, as I said, when you have real interest rates over 3%, then you start seeing investors say, well, I don't need to have so much gold in my portfolio, and you can see a negative impact. So insofar as we don't see real interest rates getting over 3% in the near term, we're not particularly worried about that. That said, we are talking about the idea that gold prices probably will peak within the next 24 months.
At what level?
On an annual average basis, we're probably looking at around $2,200 an ounce on an annual average. That would obviously suggest much higher intraday prices.
Okay. Yeah, on an annualized level at 2,200 is, well, we're pretty much almost at 2,200 today. We're 2,160.
No, we're not. Not on an annualized basis. We touched $2,200 for a while, one day.
Fair enough. Okay. So let's talk about central bank buying of gold. First of all, is it true, just pure statistics and data, that central banks have been on a buying streak last year? Can you just evaluate that fact?
Our estimate is that central banks bought about 12 million ounces of gold last year.
It was a
Uh,
record level, a record amount, was it not?
No, it wasn't. It was far from a record level. It wasn't even as high as they bought in like 2010, 2011. It's actually in line with what they've been buying on an annual average basis over the last 15 years or 15 years or so. But if you look at it, it was 20 central banks out of 180 some odd central banks that actually were gross buyers of gold. And of the 16 million ounces of gold gross purchases by central banks, 7 million ounces, or nearly half of it, was the People's Bank of China buying gold in the Chinese market. So, if you take out People's Bank of China, you had about 9 million ounces of gross purchases. You also had about 6 million ounces, no, about 4 million ounces of gross sales by central banks, primarily Uzbekistan, Kazakhstan, and Turkey, in the first part of last year, which we don't think will be repeated. But that goes, 4 million ounces of gross purchase sales, 16 million ounces of gross purchases. You have net purchases by central banks as a group of 12 million ounces, up from about 10 million ounces a couple years ago. And again, you have to remember, it's 20 central banks that were buyers. And of the buying, almost half of it was People's Bank of China.
How do we, okay. I thought, no, correct me if I'm wrong, I thought the Bank of China doesn't report their gold purchases live. Like they'll maybe 70 years after the fact, you'll see a huge jump in their inventory. But, they don't. If you take a look at data from the World Gold Council, the Chinese inventory of gold has been, if you plot it just in the chart, it's flat, 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 and then a huge spike, and then flat, 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 because they don't really report their gold purchases.
That was true in the period from 2001 to 2015, when the central bank, and actually it wasn't that they weren't reporting it, it was that they weren't buying it and adding it to their monetary reserves. They might have been buying it and putting it in a side bucket, a side pocket, a special trading account that they had. And then every so often there would be an addition to the reserves. But in 2015, they changed their policies and they said, we are adding, at that time, I think it was about 14 million ounces of gold that they had actually bought within the Chinese gold market from institutional investors and others who were selling that gold and didn't want that gold. 2014, 2013, 2014, when the price of gold went from 1680 to 1280 to 1140. There was a lot of selling within China. Chinese government's policy is the gold in China stays in China. If you can't find a buyer for the gold you want to sell within China, the People's Bank of China will buy it, put it in the special trading account, and sell it back into the Chinese market when demand rises. In 2015, they changed their policies. They changed their yuan exchange rate policies. They changed their yuan overseas RMB policies, and they changed their gold policies. And they issued a paper in which they said, we are adding a bunch of gold that we have built up in our trading account to our monetary reserves, and we will continue to buy gold within the Chinese gold market, and we will add it to our reserves. And they have actually been very responsible in reporting on a monthly basis how much gold they've been buying. Now, they stopped buying in June of 2019, and they didn't resume buying until November of 2022. And there were people who didn't know what they were talking about in the gold market who said, oh, the Chinese are not reporting their gold sale purchases. And that wasn't true. The Chinese were reporting their monetary gold reserves. They weren't buying any. So the change month to month was zero from the middle of 2019 when the price of gold went over $1,350. They said, we're not paying more than $1,350. All the way up to $2,000, $2,100 when the price came down to $1,640 in November of 2022. They said, okay, it's not $1,350, but it's off 20% from where it was 8 months ago. And so let's start buying. And they resumed buying in November of 2022. And they've been buyers every month, I think, since November of 2022. And they report how much gold they're buying and adding to their monetary reserves every month. So anybody who says, if you look at our gold yearbook, we have two charts of People's Bank of China gold reserves. We have their reported reserves, and then we have what we call our adjusted reserves, because some of that gold, if you don't do that, what you have is in the history, not since 2015, but in the period 2001 to 2015, you have these periods where they add 14 million ounces of gold to their reserves. And you have to understand, they didn't buy that 14 million ounces that year. They might have bought it over the previous 5 years. Yeah, and if you don't adjust your gold purchases for that reality, then you have this weird stuff, like you mentioned earlier. Oh my God, the Chinese People's Bank of China bought 20 million ounces of gold last year. No, they didn't. They didn't even buy 10 million ounces of gold. They took in 10 million ounces of gold that other people in China didn't want, and they sat on it waiting to find buyers.
Okay. Just going back to the overall central bank buying levels,
Mhm,
ultimately, does the central bank buying of gold have any impact on the price of gold? Someone looking at a chart of the amount of gold that central banks have bought over the last 2 years, 2022 and then 2023, may observe a coincidence. I mean, they bought a tremendous amount over the last 2 years relative to prior years, and then all of a sudden the gold price shot up 6 months later, right? I'm not saying there was a causation, but
Yeah,
certainly a
yeah.
correlation.
No, they're using bad data. If you use the World Gold Council data, it'll look that way. But if you use actual data from the People's Bank of China, it doesn't look that way. Now, there is an effect of central bank
Sorry,
on
I'm not
gold.
I'm not talking about just China in particular, but all
Right,
central banks
right,
aggregated. Yeah.
right. Let me say this in boldface italics.
Okay.
Central banks did not buy 20 million ounces of gold in 2022. And if you're using a data series that has that in there, you're using bad data. And bad data in gives you bad analysis out, right? Central banks were buying about 10 or 12 million ounces of gold in 2022, not 20 million ounces the way the World Gold Council reported. You have to understand the weaknesses in free data, right? So now to the germane question that you asked, central banks tend to be value investors compared to private investors. They like to buy low. And
Or what
so
they perceive to be low, right? That's the key.
right, right. Low by definition is a perception. You cannot tell me what a low price is in an actual concrete term. Low is relative. It's like, anyway, I can't say that. But central banks have a long-term desire to add to their gold reserves. Some central banks, 20 out of 180. Other central banks would like to add, but they haven't bought yet. They're waiting for some other reason, various reasons. Central banks are a backstop for the gold price. And you can say with good certainty that should the gold price ever fall sharply, you can define that, let's say below 1,600, you would expect to see central banks pick up gold. And again, in our gold yearbook, we have a beautiful chart that shows the relationship between central bank gold buying and gold prices. And when the gold price rises, central banks tend to buy less gold. And when the gold price falls, they tend to buy more gold. The gold price rises because private investors buy gold and they chase the price higher. And central banks say, look at these fools chasing the price higher. We're going to wait. So the price goes to $2,100 in the first quarter of 2022, based on investors in a panic over the imminent recession or whatever it was, the dollar.
So what you're saying is the central banks are the best gold hedge funds in the world, and we should just follow what they do.
Oh, central banks aren't an investor. That's the key. A sovereign wealth fund is an investor. A central bank is holding monetary reserves.
But they have a habit of picking lows, though.
They have a habit of picking low.
Yes, they haven't. Okay. One of the reasons, what reasons can you ascribe to this buying of gold over the last couple of years? Okay, the common explanation I've heard from some gold investors, gold bugs, whatever you want to, call them, central banks have bought a lot of gold last year because they're all preparing to de-dollarize for whatever reason.
Yeah, and that's why their dollar holdings remain 60% of their foreign exchange reserves. It's not a matter of de-dollarizing. It's a matter of diversifying your portfolio. Yeah, you have a lot of central banks in developing economies that have 95% of their monetary reserves in foreign currencies. Of those foreign currencies, 60% of it is the US dollar, right? And they would like to diversify their portfolio. Now, if I may, if you go back to say 1971, August 9th, 1971, and the gold dollar Bretton Woods standard ends. You had a number of industrialized central banks that had used gold for international trade and capital settlements. Germany, France, Italy, England, the United States, Australia, Canada, and they had built up large amounts of gold. They had 80, 90, 95, 98% of their monetary reserves in gold. Between 1971 and 2008, a number of those central banks, not the U.S., the U.S. did sell about 50 million ounces of gold in the late 1970s. But other central banks diversified their portfolio. They were not getting rid of their gold. They were saying, I shouldn't have 95% of my monetary reserves in gold because I have monetary reserves to protect my currency. And if my monetary reserves are in US dollars, which is what I need to sell if I'm going to buy my currencies, I can do that in the much more liquid dollar market. If my monetary reserves are in gold, I first have to go into a very opaque, relatively illiquid market and sell my gold. The banks that I'm selling my gold to see me selling gold. Oh, why is that central bank selling gold? Because it needs dollars, because it wants to sell dollars to defend its currency. So everybody starts jerking around in the dollar and the currency market of that central bank. So from 1971 to 2008, central banks said, we need to diversify our monetary reserves. We have far too much gold. And they sold several 100 million ounces of gold over that period of time, diversifying their monetary reserves and putting about 60% of their foreign exchange reserves into dollars. That same impulse to diversify your reserves on the other side of the world the emerging economies that did not accumulate gold during the Bretton Woods gold trading system, they have been accumulating dollars. They're diversifying away from dollars. With the possible exception of Russia, none of them want to de-dollarize. And most of them know they cannot and should not de-dollarize. And the strength of the dollar over the last few years and the weakness of other major economies, Europe and the UK and Japan, relative to the US, have caused those central banks to say, not only do we not want to de-dollarize, it kind of makes sense to have our reserves in the dollar because the dollar has done much better than other currencies over the last several years. And we're kind of shooting ourselves in the foot if we dump dollars and put it into euros or yen or pound sterling or Swiss franc or some other currency, right? So it's not a matter of de-dollarization. The only people who believe in de-dollarization are Vladimir Putin, not his central bank, Vladimir Putin, and crazy gold bugs. If you know anything about central banks, you know these guys are not de-dollarizing. They're trying to diversify their portfolio. And they understand fully that insofar as they need monetary reserves, they should be in US dollars because that's what they'll need if they need to defend their own currency.
Okay, let's move on. Great analysis. Thank you. Let's move on to silver. You penned a report recently entitled Silver Strength is that it is neither strategic nor critical. I'll just read a few sentences from the synopsis here. Recently, there have been calls by members of the silver market to have governments declare silver a strategic or critical metal. Such a move will be detrimental to the silver market. I've actually seen a letter penned or signed by several CEOs of mining companies here in Canada urging the Canadian government to declare it as such. And you wrote that the last thing the silver mining industry, silver users, investors, and the overall silver market needs are the governmental burdens, regulations, oversight, and involvement in the silver market that would come with the metal being declared a strategic or critical metal. Okay, help us understand this here. Why are the cons outweighing the pros of having it declared a strategic metal?
Yeah. If you look at the energy transition and energy transition metals, the one that's done the best is silver, right? And it's used in solar power. And solar power, which uses silver, has been the best and fastest growth in all of the new energy technologies. It's growing faster than wind, and it's growing faster than electric vehicles. And that's because there's plenty of silver there. You don't need to declare silver a strategic metal. Why, I guess the rationale for having that done is that then you can go to share the stock market and say, oh, silver's a strategic metal like cobalt. You should be buying our stock. And it doesn't make sense to do that. The negative is that if it were a strategic metal, then governments around the world would say, wait a second, what's our silver inventories? Who's buying silver in our country? Who's holding silver in our country? Who's using it? What are they using it for? If you look at strategic and critical metals, governments get involved in the markets and they say, wait a second, you should not be using silver for this or that or the other thing because it's a strategic or a critical metal. And you start having government imposition on the supply and demand and price of a strategic or critical metal. And the silver market, like the gold market, benefits from the fact that they're not strategic and they're not critical, and the governments just sort of say, go ahead and do your thing there. So if you want a free market, if you believe in free market capitalism, you want a silver market that is not a strategic or critical metal, that does not have governments looking over it.
Okay,
now, go ahead.
Yeah, I understand that argument. Can you outline for us the criteria for something to be considered or labeled a strategic metal?
Well, the major thing is, strategic and critical, different governments define them different ways. But the U.S. government, the U.S. Defense Department, declares that a strategic metal is a metal that is very important to the overall economy of that nation, whatever nation it is, but that has relatively scarce resources, above ground inventories and mine output and reserves and resources, and that those relatively scarce resources are concentrated in countries that could be considered adversarial. Critical metals, as the Defense Department in the US define it, are metals that are very important to the military operations and equipment and armaments and ordnance, but also come from very few places that are considered potentially adversary, right? There are other definitions of strategic and critical, but that's basically what it is. So you look at silver, it's mined in more than 75 countries. It has reserves and resources in excess of 18, well, the mineable reserves are in excess of like 18 billion ounces or 18 years worth of production. And then there's resources that don't factor into that, but at higher prices or changes in refining and mining technology could become reserves. And you have 5.5 billion ounces of refined metal in bullion bars and coins spread around the world. Yeah, so it doesn't meet the criteria of strategic and critical metals. Yeah, the U.S. government, the U.S. Defense Department has never wanted silver in its strategic stockpile, national defense stockpile. And, there's stuff that's going around in the internet that's inaccurate. It's very funny. But, the Treasury had $3 trillion, 3 trillion ounces of 3 billion ounces of silver in its inventories in the 1940s. And as the silver demand rose, the price rose, they got out of the silver currency business. They demonetized silver coinage, and they also got rid of silver certificates, $1, $5, $10 bills that were exchangeable for silver at $1 an ounce. They took the remaining 140 some odd million ounces of that 3 trillion, and they transferred it to the Defense Department in the late 1960s. The Defense Department said, we don't want this, we don't need it. But the government, the Congress and the administration said, you're going to take it. The Defense Department put it on their list of things to be sold that they don't want every year from the late 1960s until the mid 1980s. We helped create the Silver Eagle program, based in part by the idea that it would use up the silver inventories that the U.S. Defense Department wanted to sell, about 137 million ounces, and we would only sell it when people wanted to buy those silver coins. And from 1985 through 2000, 2001, the National Defense Stockpile was converted into Silver Eagles and sold to people, and it's stockpiled up in private hands all over the country. So silver is just not a strategic metal, and it's not a critical metal, and you really don't want the government getting in there and saying, well, wait a second, where is that silver? And who owns it? And why, can we have it?
Okay. Just on that note, silver and gold. Why is it that gold has been outperforming silver over the last year and over the last 2 years? If you take a look at the gold and silver prices, starting in 2022, since the beginning of 2022, gold is up roughly 20%, silver is up 12.5%. If you zoom in a bit further, starting from 2023, gold's up 15%, while silver's up only 4%. I thought silver outperforms gold during rallies.
Sometimes it does. Sometimes it does, sometimes it doesn't. Those averages will kill an investor. I think gold has outperformed silver over the last several years for two reasons. The first reason is that gold is much more universally seen as a financial asset, as a safe haven, as a portfolio diversifier. And you've seen a sharp increase starting in 2019 in investors' concerns about the economy, about the financial market stability, and about the political environment. And that has been reflected in, as I said, 24, 26 million ounces of gold on a net investment basis every year, 2021, 2022, 2023. Silver is seen less universally in that thing. So the demand has been somewhat more calm and lower than it is. It has picked up, but not as dramatically as gold. The other factor is that there were a lot of people who raced into silver in 2021 based on a bunch of, as the president would say, malarkey. The silver squeeze, and let's drain the COMEX inventories, and let's drive JP Morgan out of business. It's a lot of nonsense. And a lot of people bought silver at $20, $25, $30, $35 during that period of time in the expectation that the pundits on the internet were telling them the truth, and it would be $100 or $700 or $300,000 within a short period of time. Instead, it fell back and it's traded basically between $20 and $27 for most of the last couple of years. And you have a lot of investors who are very disenchanted and have been selling silver back into the market.
Okay. All right. Well, on that note, let's end it here. A lot of good information. Jeff,
On that
well,
happy note.
we can learn more about or from you and from the CPM group. Just tell us where to go.
www.cpmgroup.com. There's a lot of free reads. There are a lot of videos and things that you can read. There are reports that we've written and presentations that we've made, but there are also reports that we've written on a white label basis for various clients that you can download. You can also buy our reports. You can order the gold yearbook, which is released next week, and the silver yearbook, which will come out in May, and the platinum yearbook, which will come out in July. That's one place. You can also go to YouTube and see our videos and learn about what we've been doing.
Okay, good. We'll put the links in the description down below. Thank you very much, Jeff, for your time. We'll follow up again soon.
Thank you. All right. Take care.
Yeah, and thank you for watching. Don't forget to like and subscribe.